Hello everyone, welcome back to my channel. I'm Debbie Lee here with the White Samurai Investment Group today, and today we're going to be diving into something I see so many people misunderstand: the inner workings of investment companies. So we will be talking about fund managers, IPO experts, portfolio analysts, investor marketplaces, and bond marketplaces, and why understanding these roles can completely change how you see money and investing. So over this past year that I've been working at White Samurai, I have noticed a lot of working class families and everyday people think investment companies are just like some mysterious black box where your money just goes. Your money just goes in and magically it just gets bigger. But the reality, there's a whole system at play. A system made of people and strategies and marketplaces. And if you understand it, you start to see how the wealthy consistently make their money work for them. So let's start with the fund manager. Think of them as the captain of the ship, right? They are the ones that are steering where the company's money goes. But here's also the thing: the fund manager doesn't make decisions in isolation. They rely heavily on other roles like the portfolio analysts and IPO experts to give them the right information. So these roles act like engines, like the radar and the maps of the ship. So without them, even the most experienced fund manager would pretty much be like flying blind, essentially. So there's also the investors marketplace and the bond marketplace. So these are not just fancy terms for like Wall Street jargon. They're real platforms where opportunities meet capital. They are the places where companies raise money, investors find deals, and the flow of wealth gets organized. Yet most people never see or even understand them. They don't even realize that when a company goes public or issues a bond, there's a whole chain of people making everything possible. And it's these people who give investment companies the edge. So by the end of this video, I want you to see the system behind the system. The people, the marketplaces, and the processes that actually move the needle. Because when you understand this, you're not just guessing when it comes to investing. You start thinking like the wealthy, strategically and with control over your financial life. So before we get stuck into the nitty-gritty topics, I want to run us through a story, of course. So this is a story about a company that I have mentioned on this channel before, so Nike. So when we talk about global brands that have become common household names, Nike is like one of the rare companies that truly embodies the power of vision, discipline, and early investment. But most people don't know the story behind the tick, the swoosh. Nike didn't start as a multi-billion-dollar empire. It started with two men, a modest investment, and an unshakable belief in an idea. So, who are these two people? One of them, Phil Knight, was a young accounting graduate, and Bill Bauman, his former track coach at the University of Oregon. So they both shared a passion for athletics and performance. They noticed something many overlooked. The athletic shoe market was dominated by already established brands like Adidas and Puma, and yet the shoes available were often like really heavy, very uncomfortable, and even like really unaffordable for like everyday runners. So Knight and Bauman saw an opportunity, a gap in the market, and they were determined to fill it. So Phil Knight invested his own savings along with a small loan from his father to import high quality, lightweight running shoes from Japan. With this modest investment, he launched Blue Ribbon Sports. But here's a striking part of this story. Knight didn't have a storefront or a big team or a marketing department either. In fact, his first sales were made literally out of the trunk of his car. He would drive to local track meets, passing out shoes and like just building relationships with the athletes. Every dollar earned was carefully reinvested into the business, whether it was for more stock or for better designs or for understanding what runners truly needed. Meanwhile, Bill Bowerman, on the other hand, was always the innovator, the experimenter, and he was tireless. He famously used his wife's waffle iron to create a prototype sole that would give runners better grip and cushioning. Who would have thought? What may seem very quirky or small to some actually was an investment in innovation, a commitment to using limited resources to create a product that genuinely solved a problem. The waffle iron sole would literally eventually become one of Nike's first breakthroughs, proving that creativity along with strategic reinvestment could transform a modest idea into a revolutionary product. So in those early days, Knight and Bauman lived very lean. They spent very carefully and focused every ounce of energy on growing the business. They understood a fundamental principle that most people miss. You don't need a huge sum of money to create something valuable. You just need focus and strategy and the courage to invest your idea consistently. every dollar that they reinvested strengthened their product, their redistribution network, and their brand credibility. They weren't chasing flashy office spaces or like prestige. They were building a foundation for something very much bigger. So by like the 1970s, they rebranded as Nike. So inspired by the Greek goddess of victory, but the transformation from Blue Ribbon Sports to Nike wasn't just a name change. It was the result of years of disciplined investment and experimentation and resilience. The company had already built a loyal base of athletes who trusted the product, and its designs had begun to stand out for innovation and quality. So, of course, the road wasn't smooth. There were many setbacks, from manufacturing challenges to cash flow struggles, yet Knight and Bowerman approached each obstacle as an opportunity to reinvest, to refine, and to improve. They knew very early on that investments, whether it was money or it was time or it was creativity, were not just expenses, but building blocks for the long-term success. And so we fast forward to today. So Nike is a global brand worth tens of billions of dollars, recognized for performance and style and innovation worldwide. What made Nike successful wasn't luck. It was the founder's ability to take small, early investments and apply them wisely, consistently, and strategically. Every step. From selling shoes out of a car to experimenting with the waffle irons was a calculated investment in growth and vision. So, for anyone watching, the takeaway is very clear. Wealth and success don't always start big, they start smart. Nike's story isn't about instant riches, it's about investing what you have, no matter how small it is, into an idea that you believe in. It's about focusing your resources, experimenting, learning from mistakes, and constantly reinvesting in what works. That's how small investments grow into global empires. So, when you think about starting a business or launching a project or even like putting money into your first investments, remember Nike. The brand that we all recognize today started in the back of someone's car, a small savings account, and two people that were willing to risk all of their money to create value. That's the mindset that builds real, lasting success. By starting small, thinking big, and investing strategically every step of the way. And that's why when we talk about building wealth or understanding the world of investments, Nike is a perfect example. It's not just about the money that you put in, it's about smart, consistent, and courageous ways that you put it to work. So, before we dive in, I just want to cover quickly what investing is if you don't know, if this is the first video on my channel that you're watching, before we dive into anything about fund managers, IPO experts, investment marketplaces, it is very important to hit the pause button and just to remind ourselves what actually is investing and why does it matter. So many people think investing is something very complicated or intimidating or just for the wealthy, but I see this all the time, and people say, Debbie, I don't have enough money to invest, or I wouldn't even know where to start. But here's the truth. Investing is not about luck or privilege or knowing some secret code. Investing is simply just putting your money to work so it can grow over time. That's all it is. It's taking the money that you've earned, whether it's from a paycheck or a side hustle or your savings account, and making deliberate choices that allow it to earn more money for you. It's that it. That's it. It's nothing crazy, nothing magical. That's all it is. So when we're talking about investing, it's not just stocks. Investing comes in many shapes and forms, and understanding these is the first step forward to financial freedom. So, what are stocks? Stocks are buying a small ownership stake in a company. If the company grows and succeeds, the value of your stock grows. You can also earn dividends. So they are a share of the profits. And bonds, what are bonds? They are lending money to governments or corporations in exchange for interest payments. So bonds are usually lower risk than stocks and provide very predictable income. Real estate is also a big one. So investing in property to rent or to sell at a higher value later. Real estate can be a long-term growth strategy and also a source of passive income. So mutual funds and ETFs, these are pooled investments managed by professionals. These allow you to diversify even if you're just starting with a small amount. Some alternative assets are things like commodities or private companies or art, or even digital assets like cryptocurrency. These are usually high risk, but can provide unique opportunities for growth. So the first mindset shift that I want you to make is this. Investing is not gambling. It's strategic, disciplined, and deliberate. Wealth is not created by luck. It's just created by making informed decisions consistently over time. So why does it matter? Why does investing matter, Debbie? Many people in the working class live in a cycle of earning and spending, always reacting to life instead of taking control of it. And here's the problem. Inflation constantly erodes the value of cash. So what $100 can buy you today might buy you significantly less in 10 or 20 years. So if you rely on only your paycheck, your financial growth is limited. Investing changes that dynamic. Investing allows you to build passive income, which is money that works for you while you sleep, protect your money from inflation, like assets like stocks or real estate or certain bonds tend to increase in value over time. Access to opportunities. Investments give you a way to participate in companies or industries or assets that are otherwise out of reach. A plan for the long term. So retirement, property, education, or business ventures become possible when your money grows consistently. So the wealthy don't rely on luck. They rely on compounding. The principle that money, when invested wisely, grows exponentially over time. And the best part, you can start small. The key is getting started and staying consistent. So how do you start investing? Here is a step-by-step roadmap for anyone starting from scratch. So you want to educate yourself. Knowledge is your most powerful investment. Before you put your money anywhere, understand the basics. How different investment vehicles work. The difference between risk and reward. Market mechanisms like how stocks and bonds move. How investment companies operate. This doesn't mean that you need a finance degree. Just start small. Read beginner guides, watch the videos, follow reliable experts and learn the terminology. Understanding the fundamentals allows you to make informed decisions and avoid costly mistakes. Step number 2, you want to set clear goals. So ask yourself, why am I investing? Is it for long-term growth, short-term gains, or income? How much risk am I willing to take? What is my timeline for needing this money? Your goals determine your strategy. Long-term growth might focus on stocks and funds, while stability and preservation of capital might lead towards more bonds and ETFs. So setting goals ensures your investments serve your life, not the other way around. Step number 3, start small and be consistent. You don't need thousands of dollars to begin. Start with what you can. Even if it's like $50 or $100 a month. The real power is consistency. Small investments compounded over years grow into something significant. Many people wait for the perfect time to invest, but the truth is the best time to start was yesterday. The next best is today. Number 4, diversify your portfolio. Diversification is key to reducing risk. Don't put all of your eggs in one basket. Spread your investments across different assets. Stocks for growth, bonds for stability, real estate or alternative assets for additional exposure. Investment companies do this systematically to protect wealth. You can apply the same principle on your own. Diversification doesn't just reduce the risk, it gives you multiple streams of potential growth. Step number 5, track, review, and adjust. Investing isn't set it and forget it. Markets change, economies shift, and your life goals evolve. So regularly review your portfolio and make adjustments as needed. But this doesn't mean reacting emotionally to every market dip. It just means being informed, strategic, and deliberate with your money. So, What are some common mistakes that people might make? They might be chasing the trends, so buying what's hot instead of actually understanding the fundamentals. The fear of starting is waiting for the perfect moment and just losing years of growth. Ignoring the risks. Taking investments that don't match your personal risk tolerance. Overcomplicating it. Believing investing is only for experts. It's not. It's for anyone willing to educate themselves and take consistent action. So, the mindset shift, becoming an investor. Investing isn't just about money. It's about becoming someone who seeks opportunity, takes control, and builds wealth systematically. Every time that you invest wisely, you reinforce wealth identity. You're telling yourself, I am capable. I am strategic. I am building a future that works for me. Mindset separates those who create lasting financial freedom from those who remain stuck in the paycheck to paycheck cycle. So, just as a little summary for getting started, you want to educate yourself, know the basics before risking money, set clear goals, start small and be consistent. Even modest amounts compound. Diversify to spread the risk. Track, review, and adjust. And adopt the wealth mindset. So see yourself as someone who grows and controls their wealth. By mastering all of these fundamentals, you will be ready to understand how professional investment companies operate and why roles like fund managers and portfolio analysts and IPO experts exist. You'll also see why investors and bond marketplaces matter in creating long-term wealth. So, this brings us to topic number 1. The fund managers and IPO experts. So, let's break it down. A fund manager is a person who decides where the investment company's money goes, which stocks to buy, which stocks to buy, which bonds to hold on to, which sectors to focus on. They are accountable for the fund's performance. And their decisions can mean the difference between a good year and a terrible year. But here is the secret that most people don't realize. The fund managers don't act alone. They rely heavily on portfolio analysts for research and data, and the IPO experts for access to exclusive deals. So that brings us to an IPO expert. This is a person that understands the entire process of taking a private company public. They know which companies are about to launch, what the valuation looks like, the regulatory requirements, and the timing. In an investment company, an IPO expert is the bridge between private opportunities and the fund manager. They bring deals that most of the public doesn't even see yet. Early access to potential high growth investments. That is something that we would all love, wouldn't we? So when a fund manager gets a potential IPO deal, they don't just buy blindly. The portfolio analyst steps in to evaluate the company's financials, model potential returns, assess risks, and compare it to the competitors. So the fund manager then makes the final call. Think of it like this. The IPO expert opens the door. The portfolio analyst inspects the room, and the fund manager decides whether to walk in. So this is why wealth compounds differently for those who understand these systems. While most of the working class investors might be chasing trends or reacting to headlines, or investment companies have layers of expertise guiding every decision. It's systematic and it's very strategic, and it's how the wealthy consistently stay ahead. So this brings us to topic number 2, the portfolio analyst. So a portfolio analyst is like the engine room of the investment company. They do deep analytical work that makes smart investing possible. They track markets, analyze company financials, monitor the portfolio's risk exposure, and run models to forecast potential outcomes. Without them, fund managers would be making decisions in the dark. Portfolio analysts are responsible for daily monitoring. They check performance against benchmarks, they spot risks and build detailed reports. They also assess IPO opportunities and bond investments. So essentially, they are the ones making sure the fund manager has all the information needed to make smart choices. An investment company in an investment company, the relationship between portfolio analysts and fund managers are critical, so critical. Analysts are not making the final investment decisions, but all of their work directly informs the strategy. If a portfolio analyst misses something, maybe a market trend or a risk signal or a financial discrepancy, the entire portfolio could suffer. So portfolio analysts also bridge the gap between new opportunities and execution. For instance, when an IPO expert presents a pre-IPO deal, the analyst runs the numbers, looks at the market conditions, and evaluates the risk to reward ratio. This ensures that when the fund manager makes a decision, it's based on the data, it's based on the research, and it's based on analysis, not just speculation. So, this brings us to topic number 3, investor marketplaces and bond marketplaces. So, let's talk about the marketplaces, the very foundation where capital meets opportunity. So, the investors marketplace is essentially a hub where investors meet opportunities. It could be online, it could be offline, it could be part of a private network. So here, investors can find IPOs, they can find startup deals, they can find real estate projects, hedge funds, and any other investment opportunities. Companies and fundraisers get exposure to a pool of potential investors, and investors get access to deals that they couldn't find on their own. Pardon me. This marketplace is very critical for investment companies because it centralizes opportunities. Instead of chasing deals randomly, the company can access vetted, structured opportunities in one place. The wealthy leverage these marketplaces to find very exclusive deals before the general public knows that they exist. So, the bond marketplace. A bond marketplace is very similar, but instead of stocks or startups, it deals in debt instruments. So governments, corporations, and all of the like-minded institutions issue bonds to raise capital. So investors buy these bonds, earning steady interest while the issuer gets funding for projects or operations. So the bond marketplace includes the primary market, where bonds are first issued, and the secondary market, where bonds are traded amongst investors. This is an essential tool for investment companies that are seeking low risk, very predictable returns and portfolio stability. So the bond market might not have the excitement of IPOs, but it is the backbone for long-term disciplined wealth building. And investment companies use these marketplaces strategically. The fund manager decides where to allocate funds. The portfolio analyst evaluates the risk and return, and IPO experts provide early access. So all together, they all create a system where money grows intelligently and very sustainably. So, if you want to see this in action and learn how to actually apply some of these strategies to your own financial life, please check out the White Samurai Investment Group YouTube, where they speak about most of the things that they do. And please also check out their website. I will link it in the description box below. So we at White Samurai provide insights, we provide the tools and the guidance to help working class and middle class people build wealth intelligently and safely and very strategically, just like all the experts do. So, as a summary for this entire video, investment companies are more than just money moving machines. They rely on the fund managers and the the portfolio analysts, the IPO experts, and marketplaces to make smart, data-driven decisions. By understanding all these roles, you can start seeing how wealth is created systematically, not just by luck, but by structure, strategy, and access to the right opportunities. So, I would also just like to thank everyone for making it this far in this video. If you liked this video, let me know in the comments below, and check out all my other videos on this channel where I talk about financial freedom and investing and building businesses alike. And let me know if there are any particular topics that you would like me to talk about in future videos. And again, thank you for making it this far. Don't forget to like, comment, and subscribe to my channel. And check out the White Samurai Investment Group for all of your detailed questions that you need answering. They have a queries request on their website, so just fill it out if you're intrigued, or leave a comment, message me, and myself or the team will do our best to get that to you as best as we can. Thank you for watching this video, and I will see you in the next one. Bye.